FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is 6/11/20. Well, don't have to tell you with the chaos going on. You've been watching precious metals, especially if you've been listening to this show for any length of time, and you know that it has been the resumption or the start of a new bull market in the metal sector, certainly for gold, and silver is starting to come along. And we haven't talked to this person in quite some time, but we do value his opinion greatly because controversial or not, he's got his hand on the pulse of the market, and he's been in it for several market cycles now. So there's no substitute for experience. Before we get to that, where do you think precious metals are heading? And have you made money in the present bull market? We'd like to know. Just email us, kl@kerrylutz.com. And Jeff Christian is with us from CPM Group. You know him well. Jeff, it's great to have you back on the show. And, well, I guess it's official. We're in a precious metals bull market, right?
Yeah, it's funny because we've been talking for about a year what we call the stealth bull market in gold. And gold prices are at record levels and probably will be, the average price this year will probably be higher than the record average price in 2012. But a lot of people haven't realized that the gold market was rising. And we had a lot of people from September last year into March, even April of this year, who were saying, well, when's the gold price going to rise? And it's like, well, I'm sorry, but it already has. Yeah, we're in a bull market.
Yeah. And obviously in every market, well, there's a number of factors, but the main things are supply and demand. So as far as supply goes, it looks like supply peaked a couple of years ago. We've kind of been going down as far as production from the world's mines. And after the pandemic, it'll go down even further. What's the supply outlook here?
Well, gold production peaked really several years ago from mines, and it has been falling somewhat over the last really 8 years, I think, probably. But secondary recovery from scrap, old jewelry and electronics, has actually risen. So total supply of newly refined metal has been roughly flat and slightly lower. Now this year it's going to get hit because we had a number of mines shut down as well as refineries for several months in the first 4 or 5 months of this year. And it's not clear what it's going to look like at the end of the year. In China, they are coming back gangbusters now that they've lifted their lockdown. And they think that by the end of the year, production may well be relatively flat from where it was in 2019. 2019 was down from 2018. 2018 was down from 2017. Production and currently refined supply of gold is hanging in there at pretty high levels. Fabrication demand is also getting hit this year, and that's probably more of an offset right now for gold. In silver supply peaked just a couple years ago, and it's off, and it's going to fall further this year because of the mine closures due to the pandemic, and the fact that refineries were also closed, so you couldn't get scrap, and you had a lot of metal backed up there. And then fabrication demand is probably going to be off sharply this year, simply because people are not buying a lot of jewelry. Electronics may spring back. The solar panel demand, which was a big emerging market for silver demand using solar panels, that has been hit in the first part of this year, but we think that it'll spring back in the second half of this year. It is what it is. And then the key, of course, is investment demand, which it's rising for gold and silver, but it's still very low in terms of physical demand for metal right now, except in China.
Right. And we'd actually talked about this back in 2018, because at that point, the people who were buying gold as you discussed, were people who saw it or perceived it as an undervalued asset. And clearly they were right. And but that, you said, and I agree with you, was a major change from your typical gold investor who perceived it more as an insurance policy against chaos, against currency, I don't want to say collapse, but currency issues, volatility for sure. And so your feeling was that we're kind of going to be in this range until those insurance buyers maybe came back. Are they coming back?
We saw a little bit about it in March. I mean, investment, yeah. What we've seen, and the gold and silver prices rose sharply last July and August. But if you looked at it, all of the buying was in futures and options and forwards and ETFs and leveraged ETFs. And these were shorter term people looking to make money because the price was rising. It's the value investors, it's shorter term investors, and a lot of the activity was in paper gold and silver as opposed to physical gold and silver. And what you saw back then was very low demand for coins and bars from those longer term wealth preservation people. And that continued into February. In March, when the pandemic really hit full force and Europe and the United States shut down, you saw a surge in demand for gold and silver, and there was no follow-through. It disappeared. In April and May, we've seen very low demand for physical metal from long-term investors in Europe, the United States, parts of Latin America. A couple parts of Europe, you've seen some demand. Where India, extremely low demand for gold and silver right now because they're still in a lockdown. The shining part is China. China has opened up again, and economic activity is booming, and you're starting to see stronger demand for physical gold, not only from individual investors, but also from institutional investors than you've seen for several years in China. And it'll be interesting to see as the rest of the world opens up, will investors start coming into the physical gold and silver markets? We just don't know. But you're seeing that in China, having gone through the ringer from January into May. Now that they're out, you're seeing a lot of demand in China for physical gold and silver.
All right. And is that demand coming from the asset protection sector or asset preservation sector, or what? Because China, their real estate markets until recently were booming. There was a lot of positives there.
Yeah. The demand for physical gold is asset preservation. Or, for the institutions, they call it beta. I mean, we know one very large fund in China, which has an enormous position on Comex gold futures, but they're not gold investors. It's all a hedge of their global stock and bond portfolio. And when the fund managers say, well, maybe we should look at gold for alpha generation, capital appreciation as well as capital preservation, their senior managers say, no, it's just fine as a capital preservation tool. So you're seeing a lot of capital preservation, not only with institutions, but also with individuals. They're very much concerned about the state of the country, China, the state of the world, and the fact that you could see a second wave of the pandemic.
Right. So as far as the Comex goes, what is the deal with the inventory there? There's been all sorts of stories and a lot of maybe misperceptions about it.
Yeah, there's been a lot of misperceptions about it. I mean, basically what you've seen, look, gold and silver inventories are at record levels in New York, London, Zurich, Shanghai. There's a tremendous amount of metal that has been built up in inventories. One of the things that you've seen in New York is that they started it a lot because there was a tightness in terms of relative, the short position on Comex versus the inventories there. And you have to understand, one of the problems that we saw in March and April is that when you are a physical investor and you're selling gold and silver, you tend to sell that in the over-the-counter market. You've got physical metal, you go to a bank or a bullion dealer and you sell it. That bank or bullion dealer buys it in the physical market. They then have to hedge their position. In many cases, they have loans that they use to finance their trading, And those loans have provisions that say you've got to be fully hedged on a daily basis. At the end of your business day, you better be fully hedged.
Right.
So these guys have been buying a lot of gold and silver in London, taking physical delivery of it. The London market was having credit constraints because of the financial crisis. They didn't really have the capacity to hedge it in the forward market. No one wanted to buy physical metal, so they were hedging on the Comex. So you had this large short position build up on the Comex, which was a hedge of the physical metal in London. So you had this dichotomy of a glutted London market in terms of physical metal and a very large short open position in the April contract, then the June contract, and now the August contract on Comex. And so the Comex needed some liquidity, so they allowed 400-ounce bars to be delivered. Hasn't really worked out well, but you have seen about 3.5–4 million ounces of 400-ounce bars that were in those depositories already, but they were never reported as being eligible or registered because they weren't eligible because the Comex didn't take 400-ounce bars. So it wasn't so much that a bunch of people delivered 400-ounce bars in there. Those 400-ounce bars were stored there, but once the 400-ounce bars became deliverable to Comex, they showed up on inventories. So if you look at Comex inventories, they've risen sharply. But 3.5–4 million ounces of that was the 400-ounce bars. The rest of it is metal that has been coming into the market and being sold. And a lot of that is people who owned it, investors, institutional and individual investors who have been selling their gold because they wanted the liquidity and because the price is at record levels.
Okay.
So that's really what's been going on there.
All right. So we saw gold, silver take a hit when the market took the hit in March, mid-March,
Right.
But it rebounded really quickly, much faster than in 08 and 09, where it took a number of months, I think around 6–8 months to recover its losses. It went under 1,000 back then. What are we to make of that price action now?
FSN Radio. It's all about what's next.
Trilogy Metals is a world-class developer in Alaska's Ambler Mining District. The company already possesses 8 billion pounds of copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and now over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% IRR. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades on the New York and Toronto exchanges under the ticker symbol TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
The Financial Survival Network. It's all about what's next.
Well, I think that the price action reflected the difference between the March financial crisis and the 2007 to 2011 crisis. Mm-hmm. I mean, if you remember, the recession started in late 2007 and ended, in early 2009. But the financial crisis, the global financial crisis, really went into late 2011. Right. Early 2012. And you had an extended period of time when you had a very critical issue. And you even had some things like, for example, in Europe, there were laws that prohibited the European central banks from issuing bonds based on other countries within the Euro system's balance sheets. So you had a lot of problems that have been changed since 2011, 2012. To make it different. But what you saw this time in March was really a much more shorter term abbreviated financial crisis because the world just stopped. And then once the world stopped, they said, okay, now we've stopped. We've taken our hit. Now we're going to rebuild. And so you came back relatively sharply initially. And the question is, where do we go from here?
Yeah, good question. One other question. JPMorgan Chase, from what I've read, they're sitting on a huge hoard of silver, huge hoard of gold. A, is that correct? And B, what does it mean? Why have they positioned themselves this way?
It's somewhat correct, but basically incorrect, and it's meaningless to the price and to the market. First off, a lot of people who say that are looking at the JPMorgan vault reports to the Comex. And that's not their gold. That's not their silver. That's a depository where anybody comes in and says, I want to store gold and silver here. So when you see those amounts of metal that are stored in JPMorgan's vaults, that's not JPMorgan's metal. But the people who comment on gold and silver know so little about the market, they haven't picked up on that. Now, that said, so the first thing is, yeah, it's not really there. Second thing is, there is some there, but it's not JPMorgan so much, it's other banks too. And what it is that if you look at the way gold and silver trade, mining companies sell forward, the smelters and refiners finance their inventories by selling it to banks and brokers and leasing it back during the processing stage. And then the different fabricators in jewelry, silverware, electronics, they all lease their metal out. It's a perfect hedge for them. I'm going to lease the metal. A lot of these guys are actually small companies. So a lot of them are private companies. Their cost of money is anywhere from 10% to 18%, if they can even get credit in the last 10 years. So they can borrow gold for 3 or 4 or 5%, lower their costs of borrowing, and then as they use it and when they're ready to sell it, their product, they buy the gold that's contained in the product. And they pay that price of that day, and they sell their product at that price that day. So it's a perfect hedge, and it lowers their costs. As a result of this, you have mining companies, smelters, refiners, all sorts of semi-fabricators, people who make plating salts, wires, plates, semiconductor plated strip, electronics components. All of those people basically are leasing their metal from financial intermediaries, banks and brokers. The banks and brokers, as I said, usually are using borrowed money, and their loan covenants say you have to hedge that stuff. So you will see, if you saw the book, the bullion book of a bank, JPMorgan or somebody else like HSBC that's involved in these markets, you would see that they own a lot of metal, and it's all leased out. It's leased out to smelters, refiners, fabricators, semi-fabricators, even retailers. You'll have a jewelry company that has gold jewelry in department stores around the world. They'll lease that gold and hedge it in the market. So a bank, JPMorgan or somebody else, will have a large physical inventory. It's fully hedged, either in the futures or the options or the ETF options or the forward market. And they do own that stuff because that's the grease that makes the metals market work.
Interesting. So, yeah, because I never quite caught on. So the lease effectively allows them to loan the metal, retain ownership of it, so they have a security interest in the inventory. Mm-hmm. And should that borrower have problems, they can go and repossess it or take possession of their metal effectively, right? So
that's the major risk they're taking, is that somebody goes bankrupt or the metal is stolen, and they, have to find a way to get their assets back. Yeah.
Right. So it's a form of asset-based lending effectively, and mm-hmm. as the purchasers consume it and sell their product, then they're effectively paying back. They're buying the gold that they've already leased effectively. Do I have that right?
And yeah, on any given day, a manufacturer that uses gold or silver and some other metals too will call up their bank and they say, okay, I am shipping product that contains 100 ounces or 1,000 ounces of gold. What's your price? Oh, it's $17.26. Okay, I want to buy 100 ounces of gold at $17.26 off of my lease, and I want you to ship me another 100 ounces of gold in the form I want for my lease, to top off my lease, because that's my working inventory.
Yeah.
And on every given day, these guys do that.
I see. Okay, so the market is a lot more intricate than people realize, and the futures markets really do play a vital role in production at all levels. Then this is industrial as well as, like you said, for jewelry fabrication and any type of use, basically, right?
Yeah, every so often, well, it hasn't happened in decades, so I guess the industry's learned a little bit. You would get mining companies to say, I want to sell my gold directly to jewelers because I sell it to a bank and I they have all kinds of fees and charges and stuff. I want to sell it directly to a jeweler. Say, okay, fine, here's the deal. The jeweler doesn't want unrefined gold at your mine. They want gold that's refined, and maybe they want it in wire form or sheet or grain or bars. And they want it on lease, and they'll pay for it when they sell their jewelry. And the mining company says, no. I want somebody to pick it up at the mine site and pay me, within 20 days.
Yeah.
I said, well, that's not a jeweler. And then you will have jewelers who come to you and say, hey, I'd like to buy directly from the mining companies because I'm paying all these fees to the banks. So you're fine. Here's what you have to do. You have to fly down to Mexico or South Africa or Colombia. You have to buy the gold, pay for it within 2 weeks, right? Have it smelted, have it refined, have it converted into the form you want, and it's yours. Like, no. I want to borrow the gold from the guy, and I'll pay him when I sell the jewelry. Well, that's not what a mining company does. Banks exist because the world needs financial market intermediaries.
Yeah, so they're a pure intermediary here, really playing their function here. But when we see like massive amounts of contracts, many times more than the physical supply out there, what are we supposed to think about that? Is that a healthy market? Is that the way it should be? Speculators?
The question is not how can you have so much open interest in Comex? The question is where's the rest of it? If you think about the silver market, you've got 1 billion ounces of annual supply and fabrication demand. Now, as I said, you got mines, smelters, refiners, semi-fabricators of various sorts, then wholesalers and retailers. You put that all together and you have maybe 10 companies that are buying and selling and leasing metal. So you're not talking about 1 billion ounces of metal a year. You're talking about 10 billion ounces of turnover, and it happens several times a year.
Right.
So you start saying, okay, so now I can account for I can account for if that's the number I'm dealing with, and I've got half of that in Comex open interest, where's the rest being hedged?
Mm-hmm. Yeah.
If you know about it, if you understand the way the metal moves. Now, to be fair, there are people who pretend to be competitors of ours, and they say that when a mining company sells forward, there's somehow or other physical metal involved, which is not true.
No.
And when a mining company unwinds a forward, they have to go buy the gold someplace to unwind the forward, which is not true. Forwards are paper contracts. They're like mortgages or loans, right? They're paper contracts. They're based not on physical metal being bought and sold on a spot basis. They're based on the creditworthiness of the counterparties, which is why there's no such thing as the forward price, because the forward price depends on who you are. A central bank will have a different forward price than a small privately owned jeweler in New England, right? So if you understand that, then you understand that there's no metal there. And these guys say, with the mining company forwards, it affects spot physical purchases and sales. But it doesn't seem that they don't take into account that these forward transactions are also occurring at smelters and refiners and semi-fabricators and fabricators and wholesalers and retailers. So there's this gigantic disconnect because they don't even know what they're talking about.
Right. And obviously, these guys have to hedge because when you have a move like you had in silver and in gold, if they hadn't been hedging, they'd all be out of business.
It's not only that. They would be out of business. And you saw, for example, during the Hunt crisis, Minpeco, which was the Peruvian state silver metals marketing company, overhedged its silver. And when the price fell, they went bankrupt. You have to hedge just from a prudence perspective. But insofar as you're using financing and borrowed money to finance your trading operations, your banks, your financial sources are going to say, I want you to be fully hedged. It's very funny because back in the 80s, there was a guy who got in trouble with the CFTC. And he claimed he tried to get the CFTC to be lenient with him by saying that he could show how Drexel had been jerking the market around. So the CFTC investigated Drexel, and they found 2 trades which were matched trades, where they had gone to another company aftermarket and said, I need 100,000 ounces of silver overnight. Will you sell it to me at this price? And then tomorrow morning when the Comex opens, we'll cross this trade on the Comex and get rid of the OTC principal-to-principal contract. And that was illegal back then, matched trades. They were replaced by EFPs, which allowed people to hedge themselves in the aftermarket.
Right.
Basically. So this guy said, Drexel's doing this. They're jerking around the market. What the CFTC found were 2 instances of matched trades. And the fact that they were doing matched trades is evidence that they didn't have unhedged positions, right? They were doing the matched trades because their financing sources said, you have to be fully hedged.
Right, right.
So it's prima facie evidence that your theory that Drexel was jerking the silver market around didn't work. Now, Drexel went bust, so the guy said, it wasn't Drexel, it was Merrill. Merrill got out of the metals business, and he said, it wasn't Merrill, it was JPMorgan. Yeah. It's like, wow, that conspiracy is really good because it's gone from 3 companies, countless traders, and no one's ever snitched.
Yeah, and that's just not the way things work on Wall Street. We know that when it hits the fan, the first guy out gets the best deal, and they're all racing to make the deal because it's one thing they know how to do is make deals. So, looking ahead here, world turmoil, everything else, markets in the coming year. Let's just say going into 2021, we're going to keep seeing the bull proceed here. Your opinion?
We think that the bull proceeds. We think that gold and silver go to record prices 2023, 2025. We think that the second half of 2020 and into 2021, you might see the prices continue to rise, but at a slower basis. So we're not necessarily seeing prices run away in the next 18 months. We do see prices rising to record levels, but we think that the real financial crisis is further out.
Yeah, this was just a dress rehearsal, if you will. And so record prices, well, silver is the only commodity in the past 40 years that hasn't hit a new high, right? Is there like pent up demand here, pent up price action in silver?
I don't know that there's pent up demand there. I think, silver has a number of problems. One is that no one markets silver to investors. And when they try to market, they do a very bad job of it. And investors have become much more focused on gold rather than silver. And there is a lot of silver. Gold and silver and platinum and palladium, unlike other commodities, there are large inventories of refined metal above ground. With gold and silver, it's becoming public because the London banks are starting to report how much they have, and the ETFs have brought a lot of silver and gold that used to be held by investors in private unreported stocks into ETF stocks. So you're seeing more how much metal's really out there. And I think that sort of serves as a little bit of a breaker on silver. I do think that the silver price could rise sharply, but there needs to be some investor education on it. And I just don't see anybody who's in the position to provide that.
Yeah, well, we talked last time about what was the brakes on the metals market, and people were saying, oh, it's Bitcoin this, Bitcoin that. And your contention was, no, it's the outsized returns on the broader market that is basically sucking the oxygen out of the precious metals market. And I think you were correct because Bitcoin eventually crashed. And, it hasn't regained its luster, if that's the right term. Bitcoin
was a few $100 billion total open interest, and it's a totally bogus thing. It's based on the full faith and credit in somebody who's anonymous on the internet who can disappear tomorrow. And that's happened several times already, But you've got a multi-trillion dollar gold and silver market, and you have an equity market that's like $80 trillion. even with the decline. So you've got an enormous pool of money that's going into stocks and to a lesser extent bonds and currencies. That's where the money is, to quote Willie Sutton.
Yeah. So, and it's continued, and yet do you foresee the day when more money starts pouring into gold and silver for whatever reason, education or other?
And again, I think it could be 2023, 2025, but it's a wet finger in the air. I mean, we have a chart that we supply our clients every month, which is a bubble chart, and it shows all the things that could go wrong in the world that could cause investors to say, I really need to have gold and silver. Yeah. And those bubbles have gotten bigger, and they have become more important over the last 10 years, 12 years since the global financial crisis, but they really haven't come home to roost. They started to come home to roost in the last 5 months, but they've backed off. And I think that the monetary and fiscal managers can stave off the day of reckoning for a few more years, but there's going to have to be some severe adjustments. And with the deterioration of international cooperation among governments and the deterioration of U.S. hegemony around the world, I think that, if I had to put a guess when that happens, I don't think it's 2020. I don't think it's 2021. I think this is a dress rehearsal. As I said to one guy, I said, this is not peak fear. I know peak fear when I feel it. And this is not peak fear. I think that the day of reckoning may be several years away.
It could be as much as a decade for all we know. Right now, hegemony is in place, but obviously it's starting to erode. It has been for a decade already. We know that, maybe 2 decades. And so when you look at the market then, but there still is maybe people wising up to these facts, and then they start chipping away a little bit at the money they're putting into the market. Say, hey, it wouldn't hurt to put 2% of our money into gold or whatever. But precious metals, aside from investing in ETFs and other type of vehicles, really presents a lot of problems for institutions, right? To actually hold physical gold. That's not what they want to be doing, is it?
Well, there's all kinds of issues. I mean, there's some negative tax consequences for fund managers, management companies that are long-term investors, and they can get around that by buying a gold indexed bond. And quite frankly, it's easier for them. It's less costly for them. They give up some of the upside, and they give up that physical, I need to own that stuff, but that's not what institutions are looking for. Individual investors, yeah, they should have some physical gold and silver, and they should have it squirreled away in various parts of the world. And that's really the key for the price of gold and silver and that long-term physical demand. It's not the big institutions, it's the individuals.
Right. And I guess they're getting wise. I mean, you don't have to be a psychic to know that something big is going to happen down the road here. Like you said, you've got all these bubbles or black swans, if you will, and they've managed to put them off for now, but who knows when, and that's the big question, I guess. Well, hey, Jeff, we really appreciate your taking time out for your day, from your busy day, to help educate us about these markets, because, like you said, there's not enough education in these markets for investors to understand, A, the risk in the system as it stands now, why they need to hedge that risk, why you need a core holding of precious metals, not to say sell everything and put it all into metals, because that's a foolhardy endeavor. But the fact that the market works a certain way, and that provides an explanation, a rationale for what we see, the numbers that get reported from the markets and from the banks that hold the metals. So we appreciate that. And the best place to find you and read your work these days?
www.cpmgroup.com. And you can send an email to info@cpmgroup.com and say, tell me more about your services. We have gold, silver, and platinum yearbooks that are like $160. Those are the best entry place to learn about CPM Group, to see the depth and breadth of our research and data. and to sort of have a very good overview of where these markets are at any given time.
All right. Hey, Jeff, really appreciate it. Any questions or comments out there, just email us, kl@kerrylutz.com. Make sure you go to our website, sign up for our newsletter, financialsurvivalnetwork.com. Jeff, been a pleasure. Thanks so much.
You're welcome.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.